A lot of this, of course, is because of the inflation reading coming in hotter than expected. We've got a great panel of experts to help walk us through this. Angelo Menelatos from Bloomberg Intelligence and Tom Essaye, founder and president of Sevens Report Research. Gentlemen, Angelo, I'll start with you. The market reaction, very swift. We were trying to be positive going into the print, and then that turned on its head when we got the highest core reading in 40 years, signaling that those rate cuts, if they're working, they have not worked its way through the system. What are you seeing on the fixed income side?
Yeah, I think the market reaction was primarily driven by what we saw in core service prices, especially those core service prices excluding rents, because we know the inertial impacts of rents are going to keep core services underpinned for quite some time. But if you look at those prices excluding rents in a series I create every month, you saw almost a double month-over-month increase versus last month. And the market seeing that and seeing those higher prices and knows that the Fed's going to have to continue moving at these 75 basis point clips, repricing the terminal rate higher today by around 25 basis points, and maybe showing that the Fed's going to have to hike towards 5% territory.
I want to unpack the components of inflation, because a lot of people will point to the good side of things and note that, shipping costs have come down. There's a rollover there signaling that we could be getting an easing of inflation on the good side. But to your point, inflation is proving like pretty insidious and is creeping into the services side and is, I guess, harder to tamp down.
Yeah, exactly. So just looking at those month-over-month prints, let's break down everything from core. So looking at core goods on a headline level, flat month-over-month. Core goods excluding used cars, positive month-over-month, showing like an annual month-over-month gain of around 3.25%. And then used cars obviously down around 1% month-over-month. You typically see that in September, favorable seasonals, but more of a drawdown than seasonals were expecting. But on the services front, you're looking at 0.8% month-over-month services. That's blowout. That's most of the index is there in services. And there's a lot of chatter about how it's all OER. That's not the case. We saw a rapid acceleration in categories excluding owner's equivalent rent in those rent indexes.
Tom,
talking about those rent indexes, though, sorry.
No, well, I was just going to bring it to Tom because, as you go through those numbers, investors want to know, what can I do? How do I inflation-proof my portfolio? Because going 60-40 stocks bonds has not been the winning strategy. What are you telling investors if inflation is going to be persistent, as it is, according to this print? How do investors inflation-proof their portfolio?
Good morning, everyone. Thank you very much for having me on. I think they have to go defensive. To Angelo's point, we're seeing now service inflation really embed in the economy. There's only one way you fix that, and that's by slowing growth. And that's exactly what the Fed, the Bank of Canada, and every other major central bank is trying to do, because those service prices will only go down once demand for those services evaporates, and that means higher rates. It also means recession. Whether it's shallow, whether it's deep, we're all going to find out together, but it's coming. So we think that going defensive in your sector outlook, in your equity allocation, is the way to survive the continued turmoil we're going to have in the markets.
What does going defensive mean? What are the sectors?
Healthcare specifically, we like a lot. We saw that actually in Walgreens Boots Alliance earnings this morning. Their pharmacy and healthcare revenues were strong. The front of the store, like, your sort of impulse purchase stuff, not so much, but there was a focus there on healthcare. Consumer staples, the grocery stores, right? Yeah, sure, prices are going to come down, but demand is inelastic. There's still going to be money to be made there. And then finally, something like a utilities, look for yield, look for income, and look for steady demand.
When you see what's going on in the bond market right now, some of these yields, especially on the U.S. 2-year, Angelo, being taken to levels we haven't seen since 2007, there's always questions about, is the market functioning properly? Can it withstand these kind of moves? The UK has been kind of the poster child of that. But what do you say to that concept, that idea of market functioning when you're seeing these kind of extreme moves in the bond market? A few times we hear about how liquidity is a bit of a concern. How concerned will the Fed be about the market's reaction to the inflation print?
Yeah, so the Fed is the Fed is definitely keeping an eye on there. If you look at recent commentary from Lyle Brainerd, some commentary yesterday from Treasury Secretary Janet Yellen, and the real issue is, so you get these large moves, and we have an intermediation capacity in the Treasury market, be that traditional dealer market makers or buy side players. So when there's these flux in the these large moves or these events happening in the Treasury market, dealers aren't able to expand their balance sheet. Market makers aren't able to expand their balance sheet enough to, and then you see even volatility even get larger, and you see even larger moves in the Treasury market. So yeah, liquidity is relatively poor across the curve, and that is something they're looking at. They're kind of in a single mandate mode here, and as long as inflation continues to be elevated, they're going to continue to have very strong forward guidance, like we saw in the minutes. And
yeah, I was just going to bring that up, Angelo, because the line that everybody seems to be focused on from those minutes yesterday is the consensus that not doing enough would be worse than doing too much. Again, I guess the translation or the read through here is they're willing to withstand economic pain, market pain, because inflation at the end of the day is worse than either of those things.
Yeah, for sure. And I think that goes in two ways. That means a higher repriced terminal rate and staying at that terminal rate for longer versus going closer to 5% and then maybe changing course within 3 months. That is not something they're looking to do, and they're trying to make that abundantly clear. If there are some ways that they can increase Treasury market function and help there, especially if that is something that may cause them to change course in their inflation fight. So there are some changes that they can make, and I do think that at the end of the day, the Fed is resolute in getting inflation down to its target, and we'll do what's necessary, even if that means trying to aid and improve Treasury market function.
Tom, I was getting ready before the inflation print to talk about earnings being kind of a good news story. Pepsi, we thought, okay, maybe that's an outlier. That can't be repeated. But then when you look across the board, Aritzia here, Delta Airlines, Domino's, Walgreens Boots Alliance, these companies managing to do what they can to beat expectations or offer a rosy forecast. But in this market, does that matter? Do you think earnings can take center stage?
I think they can break the negative feedback loop we're in right now, right? Because we're basically all telling ourselves this really negative story. The Fed and global central banks are going to hike so much, they're going to put us into a recession, and earnings are going to collapse, right? And down we go. Well, if all of a sudden earnings don't collapse, then that kind of breaks the cycle. And we saw this in July, actually. What keyed the market bounce in June, it wasn't the Fed and it wasn't inflation, it was earnings. Earnings were much more resilient than people thought. If we see that again this quarter, it can provide a serious bounce, easily a 10% bounce in the market. Now, does that mean the bear market's over? No, it doesn't, but at least it gives us some relief. At the end of the day, earnings still do matter.
Angelo, when you look at what the market is pricing in, and you alluded to this in the beginning in terms of Fed rate hikes, it looks like, where there was maybe a whiff of hesitation for November, that's fully priced in 75 basis points. What are we seeing kind of later on down the road in terms of markets' rate expectations and how they changed with this print?
Yeah. So that the next hike changed by, so 75 is kind of baked in. They're pricing in some risk premia of a little bit of 100. Same with last meeting. Similar thing happened. We saw 10 basis points more kind of being priced into that December meeting. At this point, if you were to ask me 75 or 50 in December, I think it's going to be 75 in December as well, given this data and just, people say inflation's lag, but we're getting these month-over-month prints that are really strong, and the Fed is not into looking at any nuances. So yeah, we saw around 25 basis points in total, kind of being priced into the Fed funds curve. In where there were more cuts priced in, you saw a little bit, into those later in 2023 numbers. You saw that a little, in some way, be a little bit priced out as well, which we think is definitely something that they want to communicate, that they're going to hike to this high level and keep rates there, for sure.
Tom, I'm going to end with you and go back to, actionable ideas. You mentioned, get defensive, healthcare staples, utilities. But even in this kind of market, that hasn't really protected you. The only thing up on the S&P 500 is the energy sector. All those other sectors, defensive, cyclicals, are all down. Should investors just go to cash and wait for some more clarity, wait till the Fed goes on pause, wait till the market is ready to look at fundamentals, as you say, talking about earnings? But it seems like that's just not something investors are willing to entertain right now.
Well, they probably shouldn't, honestly, unless they're a very good trader, because if there is one lesson that we have all learned from market history, it is that timing the market is incredibly difficult, right? And that getting out now, oftentimes history has said has been the wrong move. And so what I think people need to realize is that just like stocks have led what will ultimately be an economic recession, so too they will lead the eventual recovery. It's not a secret formula on what makes this stop. The Fed and global central banks get to where they need to be, and they stop. Inflation begins to roll over, and all of a sudden we can start to look towards the dawn. We are not there yet, but it will come.